Hello again. Welcome to another session on foreign currency transactions. In this session, we'll understand what are Nostro accounts. As we saw in the previous sessions, banks buy and sell foreign currency. For routing these buying and selling transactions, banks need to maintain accounts in different currencies. So, Nostro accounts are accounts in which banks route their buying and selling transactions. Nostro is derived from a Latin word which means ours. So, Nostro accounts are our accounts on your books. In other words, these are current accounts maintained with banks abroad in foreign currency. So every bank dealing in foreign currency needs to maintain current accounts with banks abroad, and these are referred to as its Nostro accounts. So let's understand what are Nostro accounts by taking an example. On the right of the screen, as you see, we have HDFC Bank. And let's assume that HDFC Bank is dealing in only two currencies, US dollars and pound sterlings. For doing these buying and selling transactions, the bank needs to maintain accounts with banks abroad. So let's assume that its US dollar account is with BNY Mellon New York and its pound sterling account is with Standard Chartered Bank London. So these are Nostro accounts of HDFC Bank, are accounts on your books, which means in this case on the books of Standard Chartered Bank in pound sterling and BNY Mellon in US dollars. These banks are referred to as correspondent banks of HDFC Bank. Now, Nostro accounts are like Demat accounts. When a shareholder buys shares or when an investor buys shares, he needs to maintain a Demat account with a depository participant. Likewise, for a bank to undertake buying and selling transactions of foreign currency, it needs to maintain a Nostro account with a correspondent bank. To take the similarity further, when an investor buys shares, his Demat account is credited. Likewise, when a bank buys foreign currency, its Nostro account gets credited. So there are various buying transactions that banks undertake in foreign currency. Banks buy foreign currency from exporters, they buy foreign currency from recipients of inward remittance, and they also buy foreign currency from inbound travelers. Each of these foreign currency transactions result in a credit to the Nostro account of the bank. Likewise, when the bank undertakes sale transactions, it also impacts its Nostro account and the Nostro account gets debited. So when an investor sells shares, his Demat account is debited. And when a bank sells foreign currency, its Nostro account is also debited. So there are various sale transactions that are undertaken by banks in foreign currency. So banks sell foreign currency to importers, they sell foreign currency to senders of outward remittance in foreign currency, and they also sell foreign currency to outbound travelers, as we saw in our earlier sessions. Each of these sale transactions result in a debit to the Nostro account of the bank. Now, earlier we saw that such buying and selling of foreign currency result in an open position in that currency, which means that the bank may have an overbought position or an oversold position, which exposes the bank to foreign exchange risk. Also, another risk that is involved is liquidity risk. So, it is the responsibility of the Forex Treasury to also undertake liquidity management. So an overbought position can create a credit in the Nostro account. A Nostro account, as we saw, is a current account, and these funds remain idle in the Nostro account, in the current account, which does not earn any interest for the bank. Likewise, when a bank has an oversold position, its account gets debited, and this could ultimately create an overdraft in the current account with a correspondent bank abroad, and the bank will then have to pay interest on the amount overdrawn to the correspondent bank. So both these situations are undesirable, and the Forex Treasury monitors the balances lying in the Nostro account as part of its liquidity management in addition to foreign exchange risk management. So let us look at some examples to see how the Nostro account balances are managed by the Forex Treasury. So in one of our earlier sessions, we saw three simple transactions that are taken by a bank in terms of buying and selling during the day. And we saw its impact on the open position of the bank. Let's take these transactions again. Assume that the bank bought 5,000 US dollars from an exporter. It then sold 3,000 US dollars to an importer, and it again sold $300 to a sender of outward remittance. As we saw earlier, this results in an overbought position or long position of 1500 US dollars. Now, this exposes the bank to foreign exchange risk. In this session, we'll understand its implications in terms of the liquidity management of the bank. So let's see the impact of these transactions on the balance lying in the Nostro account of the bank A. So the first transaction, as we saw in the previous slide, is that the bank bought 5,000 US dollars. As we saw earlier, a buying transaction results in a credit to the Nostro account. So this amount gets credited to the Nostro account of the bank, and at the end of this transaction, the balance in the Nostro account will be US dollars 5,000. Subsequently, the bank sold $3,000. This sale transaction will result in a debit of 3,000 US dollars to the Nostro account of the bank, and its balance will then get reduced to 2,000 US dollars. Thereafter, as we saw in the previous slide, it sold another 500 US dollars, and this sale of 500 US dollars will result in a debit of 500 US dollars to its Nostro account. At the end of these transactions, its credit balance in the Nostro account will get reduced to 1500 US dollars, and this amount is lying idle in the Nostro account, which is a current account, without earning any interest to the bank. So as we saw earlier, such overbought position has to be squared by doing a sale transaction by way of cover operations. So when the bank sells $1,500 to square its position, such sale of $1,500 will result in a debit to its Nostro account, and that will make the balance nil. There will not be any idle funds lying in the account, and the bank would have also managed the foreign currency risk as part of its treasury management. Let's take another set of transactions, this time of a bank B, which we had seen in one of our sessions. Let's look at those transactions. So first, assume that the bank bought 2,000 US dollars. Subsequently, it sold 3,000 US dollars. The third transaction that it undertook was a buy transaction, a purchase transaction of US dollars 1,500. So it has bought a total of 2,500 US dollars and sold 3,000 US dollars, which means that at the end of these three transactions, the bank holds an oversold position of 500 US dollars or short position, and this position exposes the bank to foreign exchange risk. Now let us see the implications of this oversold position on the Nostro account of the bank. So let's look at the impact on the balance of the Nostro account of the bank. So first, the bank bought US dollars 2000. Such buying transaction will result in a credit of 2000 US dollars in its Nostro account, and at the end of this transaction, its Nostro account will show a balance of 2000 US dollars. Subsequently, the bank sold $3,000. This sale will result in a debit of $3,000 in its Nostro account. At the end of this transaction, it will have a debit balance of 1,000 US dollars. Then it bought 500 US dollars. This buying will mean a credit to its Nostro account of 500 US dollars. So at the end of these three transactions, it will have a debit balance of 500 US dollars, which means that there is an overdraft on which it will need to pay interest to the correspondent bank. But as we saw earlier, an oversold position also exposes the bank to risk of foreign exchange loss. So banks undertake offsetting transactions and cover their position. So the bank will buy 500 US dollars to square its position. This buying transaction will result in a credit of 500 US dollars, and its balance will become nil, and it will not have to pay any interest. There will not be any overdraft in the Nostro account, and the balance will be maintained to the bare minimum. So in this session, we understood what are Nostro accounts and how the Forex Treasury also manages the liquidity position of funds lying in the Nostro account of the bank, in addition to managing foreign exchange risk. Thank you for watching this session.